Chapter 15, Financial Crisis and the role of financial crisis in the economy. So we're going to go over two financial crises, the one in 1929, 1930s, the Great Depression, and the most recent 2007, 2009 global financial crisis that was due to the mortgage crisis in the United States. So before we go into those two specific crises, let's look at what are the steps in which a crisis evolves. Like how do you get to crisis? So the first step in any crisis is some sort of an innovation, some new change that has happened, that's introduced that was not there before. In this case, let's look at a financial innovation, an innovation where the banks, let's say 2007, 2009, were able to lend mortgage securities to borrowers which were subprime borrowers, which didn't have the right high quality creditworthiness, but they were able to do that very quickly. So that was an invention, the invention of FICO score, the invention of CDOs, which we'll get into, collateral debt obligations. So this starts with some sort of an innovation, some new thing that is introduced that was not there before, and people typically exploit that innovation. And so what happens? There's over-optimism, there is a credit boom. When you exploit that innovation, there is a credit boom where that financial instrument is exploited. More and more people get the credit's available for free, money is available for free. And so once we have over-optimism and credit boom, and if you combine that with lack of supervision and lack of regulation, because when new innovations come, regulations or rules and regulations are backward looking, and they catch up to those new innovations over time. So there will always be an innovation that will have lack of clear supervision because the government doesn't really understand all of those innovations. And so there will be lack of innovation based supervision and regulation because it has never had an issue before, because it's this very new thing. And so when that happens, the system over time will collapse around the weakest link. In the 2007-2009 crisis, the subprime borrower was the weakest link. The borrower who did not have the credit worthiness to buy that big property, but they still bought not just one but multiple properties, they were the weakest links. And so when they fall over or when they default, and when it defaults at the wrong time and there are certain consequences that happen, then you have a financial system that goes through a problem. In this case, the banks, the intermediaries, the hedge funds, in 2007, 2009 global financial crisis, they were the ones that had a problem. So the initiation phase is the step one where new things get introduced that eventually leads into a banking crisis where the banks or the financial intermediaries get impacted. And so when the financial system has a problem, what happens? You remember from the previous chapters, financial intermediaries help solve information asymmetry problems, which reduce adverse selection and moral hazard problems. But when they have a problem, the information symmetry increases, meaning the uncertainty goes up because they are themselves going through a problem. And when that happens, adverse selection goes up, moral hazards go up, and those are the problems for information asymmetry. We've covered all of this in the last chapter, a lot of detail. And so loans are then given to those entities with high uncertainty. So people in this case could be subprime borrowers. Subprime borrowers are borrowers that don't meet the credit worthiness, but they're still given the loan. And so then what happens is when these issues spiral up, the banks quickly realize that, hey, there's a problem. And so then they cut back in financing. They cut back the supply of money, saying, hey, we are under a problem, let us stop issuing these new problematic loans, let's fix the situation. And so when they cut back financing, they're cutting back money supply. And so the aggregate demand goes down. We know what happens when aggregate demand is pushed down. Remember from our AD curve, right? AD and AS. Here's the inflation and here is output. So when AD shifts down, inflation drops, output drops. So when aggregate demand is shifted down because there's a cutback, economic activity output goes down. When economic activity output goes down, the business balance sheets deteriorates because they have goods that are produced that no one's ready to buy because the demand just went down. And so the firms start, the weakest firms start to collapse. When the weakest firms start to collapse, their credit spread increases. They'll have to pay more interest to the bondholders to raise the money in the market. And when this happens, unemployment increases because if they can't sell the goods and services because the demand went down, they're going to fire people. Then unemployment will go up. When unemployment goes up, we also saw inflation goes down, right? So economic activity goes down, inflation goes down, and as a result, unemployment goes down. And so then what happens? People are like, hey, I need the money, so they're going to take the money out of the bank. And eventually they'll also feel that, hey, the bank's under crisis, I'm going to take my money out of this weak bank. So then the weaker banks, people run for the bank, meaning they run to the bank and say, hey, I'm going to take out my money. And they're going to take out the money either through the ATMs or they go to the bank branches. And so then the bank deposits of those weak banks go down. When those weak banks start to collapse, they have bank failures. This bank that had the information about certain clients, now they're going to lose that information capital because they just got wiped out. And so the information asymmetry here increases because those people that this bank was serving, now they're no longer serving them, so their information is lost. There are systems like the credit score that unify all of this, but by and large, there's some information lost here, and the bank just collapsed. And that just aggravates the financial system. The weaker banks have an impact on slightly more stronger banks, and then so the entire system goes into the negative spiral. So there's the initiation phase, the banking crisis phase, and then the debt deflation phase. So let's go over the debt deflation a little bit more. So when inflation goes down, debt deflation happens. Let's look at how. Let's say you leveraged up. You bought a $100 house. Say with me, $100 house. And you got a loan for $80 and you paid $20 down, 20%. Your asset price is $100. The house price is $100. When prices go down, your house value will also go down. So a $100 house, let's say it becomes $50. But your debt doesn't go down. You still owe the money, $80 of money to the bank. So a $50 house, you now have to pay $80 worth of debt. So what happens then is people start to deleverage. They're like, hey, at least I'll get $50. I don't know, it'll probably get to 40 or 30. So then they sell it at lower prices. So that's debt deflation, debt leveraging, because when they sell at lower prices, they are actually reducing the price of the asset further. And they're going to take that money, $50, and give it to the bank. What will the bank do? What you just did as part of that exercise is you removed $50 from circulation from the economy, because you took that $50 from the buyer and gave it to the bank. That was in circulation, that money was in circulation, but you just took that money out of the economy. What then happens, it triggers less money in the economy, meaning the prices further will go down. So debt deflation happens primarily because you leveraged up. You leveraged up, price of assets went down, your debt still remains high, so you deleverage, you start to sell at lower price. The bank again, reduces that money from the economy, and so inflation has a negative spiral. So that's the debt deflation. This is the third stage: initiation, banking crisis, debt deflation. So now let's put it in the context of, like, we've learned some of these concepts already of agency theory, but agency theory is nothing but a combination of information asymmetry, how information asymmetry causes adverse selection and moral hazard problem. If you combine these three, that's agency theory. Set of things that explain how information asymmetry causes adverse selection and moral hazards, right? And we also see the three stages of crisis as to where crisis can initiate. from innovation through banking stage through debt deflation. We also looked at how debt deflation happens due to you leveraging up. Right? So now let's look at two examples: the Great Depression in 2007, 2009 global financial crisis, and then the role of the Federal Reserve. So in 1929, 1930s, the Great Depression, around 1929, the United States government agencies, the Federal Reserve, they felt, hey, the prices are way too high, right? And that so they started monetary tightening. They're like, hey, we want to bring down these prices, right? And so they started monetary tightening because the prices were low, actually. The prices were low, so they started doing monetary tightening. And when they did that, they did get stock markets to correct. The prices came down, but then they came down quite significantly. And there was a series of factors that caused it. There was also in the Midwest a huge drought that reduced the agricultural output, and the farmers, they couldn't give back the loans. And so when they couldn't pay back the loans, the bank had a run on the money on the weaker banks. And at that time, the Federal Reserve and the fiscal policy, the government didn't act. They let some of these bank fails, almost to the extent that 1/3 of the bank failed. Stock market was constantly correcting. And so the financial friction increased because the banks were failing. We just saw output reduces, inflation goes down. So they were able to control inflation, but it went down way too much. Right? The prices fell 25%. Unemployment went up 25%. Right? So that was quite high. Imports reduced because people could no longer afford. They didn't have the money. Eventually led to fascism and World War II. So the Depression area was a huge learning for the Federal Reserve to act, right? And what happened from 1929 to 1932, the stock market actually corrected 90%. So a $100 stock market became like $10 approximately. So that was the biggest learning for the Federal Reserve. And so when 2007, 2009 crisis came in, there was a milder crisis in 1999, 2000, 2001, the technology bubble crisis. But then in 2007, 2009, they were like on it. So Ben Bernanke was the Federal Reserve chairman. So when they saw that, hey, so let's go, what was the financial crisis? The financial crisis happened because of the invention of FICO score, which basically gave a very low cost, quick way to identify the credit score of the borrower. And then there was also invention in technology. So data mining and data products came out, financial engineering, financial products came out. So what they were able to do is they were able to bundle home mortgages as securities that could be sold. And there was a high demand. Money was coming in from China and India to the United States. There was low interest rates from 2001 onwards because of that crisis. There was also an attack on the World Trade Center. And so the Federal Reserve had kept interest rate low as well. And so those two factors, financial innovation, but at the same time cheap money coming in, led to creation of these securities, mortgage-backed securities. And so there was a lot of this demand. People were like, hey, here's money. I want someone to buy this. So then the closest they could get to was subprime borrowers. Those borrowers that didn't have the right FICO score, greater than 669 is high credit, good credit worthy, but FICO score of 580 to 669 were the people that belonged to this subprime category. They were given the loans because there was no one else to take. So more and more of these loans were given, and these instruments, CDOs, collateral debt obligations, think about them as special purpose vehicles, simplified, like special purpose vehicles that can buy these set of complex debt instruments that are mortgage backed. Basically, think about it like they bundle all of these mortgages. They're like, if these high net institutions in China and India want to buy things, they would want to buy a series of those houses that are backed. So the thesis was that US home prices will continue to go up, and these were really stable ways to make money. And so this cycle increased. these CDOs were sold. The credit agencies were the ones who also helped create some of these instruments. And so then there was conflict of interest. They created these instruments, they wouldn't rate them like subpar. So the credit agencies also helped not just create some of these instruments, but also rate them. And so then that led to this cycle where the home prices just kept going up. And so the people felt like, hey, even the subprime borrowers, they were like, I have nothing to lose. If I can't pay back my loan because I didn't make the money from my salary account, then I will just sell my home and I'll get something else, because the home prices just kept going up. But then that had an issue when the subprime borrowers couldn't pay at some point. And the way it was started was, even though all of this started in the United States, in France, BNP Paribas, right? August 2007, they suspended certain transactions. Because they had a lot of losses. And so then the first time after 100 years, the bank in UK called the Northern Rock Bank, September 2007, they had to be shut down. They filed for like bankruptcy, right? The bank filed for the bankruptcy, or they just had to be shut down. So this started in France, ended up into UK, and then in the next year, in March 2008, Bear Stearns filed for bankruptcy. And then Freddie Mae and Freddie Mac in August 2008. Eventually, they were taken over by the government because of the bailout. Then Lehman Brothers in August. And then Merrill Lynch and AIG, right? So it started the weakest link was exposed, and then when they had to sell, they were doing debt deflation, right? They were deleveraging. If my home prices now all of a sudden starts to go down, then, and if I am a subprime borrower, I do not have the credit worthiness, or I do not have the financial sources to pay for those home, I'm going to sell it at lower price. And so then that started the negative cycle. So the weakest link started to expose pretty much this entire credit boom that was funded, and those subprime borrowers eventually just went under. So a lot of people lost their homes, and then that caused a lot of prices to go down. But the Federal Reserve did not stay idle, and nor did the fiscal policy, nor did the government stay idle this time. They had learned that, hey, this was a crisis, financial crisis, but if we don't want to let this to become a depression, like what we saw. Because Japan, in the 1992 to 2002, similar situation happened. They did not act. And so they lost an entire decade. Otherwise, in 1992, Japan had like 86% of per capita income as the United States, and they were actually on their way to become the richest country. And then they lost 10 years because the Federal Reserve, of equivalent of Japan, did not act to really course correct and strengthen those banks that were really solid, but instead let those banks that were weaker inflate their assets and did not recapitalize their banks as much. So then the Federal Reserve is like, no, we're not going to lose one more decade here. So they acted. What did they do? They're like, hey, no, we're going to reduce Ben Bernanke. Even at that point, it was a unusual move. He reduced the federal fund rate. It was at that point, 2007, 5%. And he went ahead and reduced aggressively and proactively the federal fund rate, and all the way down to zero in 2009. So over the next 1.5 years, he went it down to zero. He also, once it was zero bound floor of the federal fund rate, he also used the non-conventional monetary policies, where he went and gave liquidity, reduced the repo lending rate between banks from 100 basis points to 25 basis points. That was a major reduction in friction. He also went into private lending and asset repurchases, quantitative easing. He went into private lending, which the typically Federal Reserve only would buy the government-backed securities, government bonds. He went into AIG. He went to so many areas to bail them out, so that he was actually doing this. He was cutting the problem right here, so that all of these issues don't develop, right? And if you see, the impact of that was that the stimulation of the economy did happen. Banks started lending more. This entire debt deflation didn't happen. The housing market did correct, but not to the extent that it would have caused a depression. The Federal Reserve increased their balance sheet from 1 trillion to 4 trillion. Right? From 2008 onwards, 2008 it was 1 trillion, 2013 it was 4 trillion. And so not only they did non-conventional monetary policy that we see in the previous chapters, they also managed expectation. And they did it first conditionally, saying, hey, we're going to keep buying 75 billion or 25 billion every quarter, every month, or something like that. And then they eventually went to unconditional expectation setting. So they managed expectation really, really well, led to not just stimulation of the economy, but corrected the Great Depression not happening again. So one might say that, hey, 2001, 2007, there was low rates, so the Federal Reserve acted. And even the fiscal policy, there was an action. Obama, when he came through after George W. Bush, $288 billion tax cuts, $500 billion of government spending starting 2010 and onwards, right? So the Federal Reserve has a role to play. Think about this, right? All of these things, innovations are continuing to happen. The market, we know the supply-demand equation, there's an equilibrium, but you cannot expect the economy to be in equilibrium. It is a moving entity. There are things that are being introduced, so the Federal Reserve needs to be able to course correct through monetary policy, and the fiscal policy through right supervisions need to be in place. Otherwise, these crises will happen, and that could have a permanent impact on the economy as those people who are out of work will lose skills, those factories will get shut, it's very hard to restart them, output will go down, inflation can go down, and those are all really bad impacts. So understanding some of the history, understanding the role of the Federal Reserve, how they did what they did, and how it's very sensitive if they don't act, that the financial crisis can keep happening over and over. So question for you, if you're listening till the very end, what do you think is happening, right? What is the Federal Reserve's balance sheet now? That we've gone through COVID, we've gone through so much of financial balance sheets have gone up so much. What do you think is happening right now? What's the Federal Reserve's balance sheet right now? This is 2013 numbers, 4 trillion. What is it right now in 2021? Go check it out. And the place where you can check it out is the Federal Reserve website and Fred. That's where you can find out. Thanks.